Welcome everyone. As you're signing in, this is the Kaplan webinar for packaged products today. We've got a couple minutes here, so let everybody get signed in. My name is Marie, and I will be your instructor for today. Wonderful. All right, we got a lot of you coming in. So the doors are open. Everybody's filing in. Another minute, and then we'll go ahead and get started. We have a big agenda today. And how's the audio out there? You all have been muted, so you won't be able to verbally respond, but if you will open the little palette, as we're calling it, you should see a little chat box that'll open up at the very bottom. So make sure that you can find that. If you want to try typing something in there, I can see you. I will have a moderator with me today. Mark Esposito is going to be my right-hand man, taking questions in the chat. All right, so it looks like we are at our appointed starting time. And so I'm going to go ahead and begin welcoming you all. Once again, good morning. I guess for me it's morning, good afternoon for those of you that are on the other side of the coast. And welcome. This is the fourth webinar in Kaplan's free webinar series. And today's topic will be packaged products. So my name is Marie Sychowski, and I will be leading you through today's material. I have been with Kaplan for a very long time, going on 21 years and still going, teaching 7 different securities licenses. So I love being in the classroom, and I love meeting all kinds of students and hearing the many, many success stories that I've heard over the years. So, and I do miss being in the classroom because I'm used to being able to do a lot of visual presentations. So we'll make the best of it, and I'm happy to see so many of you that have joined us here today. Hope to make this time worthwhile. So due to the size of the classes, yes, all of you participants have been muted, but once again, if you'd like to ask a question, you can certainly do so. Mark will be in the chat area, and he will be fielding questions, so you can go ahead and type those into the chat box. That being said, I will also ask if you would please to keep your questions relevant to this topic, packaged products. So investment companies, variable annuities. If your question does not have anything to do with the topic for today, please don't ask it here. The chat can get pretty busy otherwise, so I would encourage you, if you have other questions, you have instructor link through your Kaplan dashboard that you can use, or you can check the schedule for future upcoming webinars and attend one of those that suits your needs to get those questions answered. So with that being said, there are some common questions that all the classes have had up to this point. So I'm going to go ahead and just kind of answer some of those now, but Mark will be also repeating the answers to these questions as we go through, because they're asked a few times. So number one, is the class being recorded? Yes, it is. So as long as you have registered, you will get a copy of the recording. You do not have to attend to get the recording. So that's something to keep in mind future webinars that we have. If you can't attend, just know you can go ahead and register for the webinar, and you'll still get a recording of the class. So now, can we get a copy of the slides? The answer to that one is no. So all the information we will be presenting comes right out of your textbook, and we are presenting just general information, topics and information that's relevant to the various different securities licenses that you all may be studying for. Just keep that in mind. We've got everything from people studying for their SIE all the way up to, you might be in one of the top-off exams or the 65, 66 exams. So just keep that in mind, that depending on which license you're taking, your information may go deeper than what we're covering here, but we're just giving a general overview. So you can find more information certainly in your respective textbook. Where can we see the schedule for and register for upcoming webinars? Mark will be posting a link to that in the chat. And most of the webinars are 60 minutes. Today's, however, and there's a couple more upcoming that are going to be a little bit longer. Today's webinar is going to be 90 minutes. We will not be taking a break. So if you need to break, you can break on your own, but 90 minutes will be going. We've got a lot of information, like I said, so grab your coffee or your lunch or wherever you're at in the day, and let's get started. Oh, I hear the audio went out. Can we hear? Can you hear me? Audio's out. Good? Can you hear me? Mark, can you let me know? Can you hear? Audio good. Okay, wonderful. Thank you. All right, so just let me know if there are any, if you lose me, then please type something into the chat there so that alerts that we have a technical issue, okay? All right, my friends, so let's go ahead and get started. As I mentioned, the topic for today will be investment companies and variable annuities, and it is going to be our goal today that after this webinar, you should be able to recognize the general characteristics of packaged products and be able to identify the characteristics of investment companies and variable annuities. So, let's kind of start just by thinking of what it is that makes an investment company different from what I usually refer to simply as just a traditional company like a Coca-Cola or Home Depot. And it's because of what they do with the capital that they raise that makes them unique. So investment companies, you learned maybe if you attended webinars 1 through 3, that corporate issuers, when they need money, capital, they raise that capital by going to the primary market, right? And so they raise that capital by issuing stocks and or bonds as a way to get the money that they need to buy equipment and buildings, do research and development, etc. Okay. Well, an investment company does the same thing. So these are companies. It can be organized up as corporations. There is one we'll talk about that's organized as a trust. And this is a company that's going to raise capital because they have a need for money. The main difference is what they plan to do with the money. Instead of buying equipment and buildings with it, they're going to use this money to go out and invest in other companies' securities. They're going to go out and buy other companies' stocks and bonds. They create portfolios of securities using mom and pop's money. And then the investment company manages that portfolio for the benefit of its shareholders, the people that provided the capital to put together the portfolio. Okay, but so if an investment company needs money to put together a portfolio and they go to the public saying, hey, we started this company, would you like to be a shareholder in our company? As a potential investor, potential shareholder, you might say, well, what are you going to do with my money? Oh, we're going to invest it. We're going to create a portfolio of securities and we'll manage it for you. And then anything that's generated off of that, after we deduct some expenses, we'll distribute the bulk of that to you. I said, well, that sounds pretty good. What kind of companies are you going to be investing in, right? So, that would be pretty important. So, prior to 1940, these types of companies didn't have to give anybody an idea what they were investing in, but because, when the government starts making rules and legislating, putting laws in place to protect the public, they said, hey, we've got these companies out there that are using mom and pop's money to put together portfolios, and they're not telling people what they're doing with the money. We think that's pretty important. People need to know that. How else can they make informed decisions or gauge the amount of risk they're taking if they don't know what these companies are going to be doing with their money? So again, going all the way back to 1940, we have a very important piece of legislation, the Investment Company Act of 1940, that said, number one, it gives us the definition of what an investment company is. And so these are companies, that pool capital money of investors, think mom and pop investors, and they use that to buy other people's financial securities, other people's stocks and bonds, other companies' stocks and bonds, okay? And they create a portfolio of securities that they then manage for them, okay? Due to the Act of 1940, the Investment Company Act of 1940, these companies are going to be required to register with the SEC, and when they do so, they do have to define what it is they're going to be investing in. They have to identify an objective. Right? So the other thing that the Investment Company Act of 1940 is important for, not only does it define for us what exactly is an investment company, but it also gives us three classifications of investment companies. And these are three classifications that you really should know for the test. I'd say the bulk of the questions are going to surround one specific classification, but you really should be familiar with the three classifications of investment companies as created by the Investment Company Act of 1940. And the first one you see there, a face amount certificate company. We'll get the differences on the slide that's coming next, so I'll just run through these right now. So face amount certificate company, we have unit investment trusts or UITs. That would be, and notice this one is structured as a trust. So again, these companies can be structured as corporations or as trusts. So this would be a investment company that's structured as a trust, known as a UIT. And these can actually be of two types, fixed UITs or non-fixed UITs. I'll just mention something on the next slide about a fixed UIT. But the bulk of your questions are going to surround your understanding of the third category here, or third classification, which is a management investment company. And these can be broken into two types. So they can be structured either as closed-end managed investment companies or open-end managed investment companies. So we're going to look at the differences here coming up in just a couple slides. But I want to point out something that is important here, and that is the term mutual fund. So you'll notice under open-end, you see the term mutual fund. Mutual fund is a term that is synonymous with open-end. They are one and the same thing. Okay, they're going to use terminology interchangeably on you, as I'm sure you've figured out if you've gotten into the Q Bank and have started working through practice questions. So you have to get comfortable with the interchangeability of a lot of these terms that can be used in place of another. So open-end and mutual fund are one in the same thing, but don't confuse that with a closed-end fund. That's something completely different, right? A mutual fund is never going to be a closed-end fund. So you got to read carefully with any of these questions about managed investment companies or funds. The first thing you need to identify or clarify for yourself when you're reading a question is, what kind of fund are they talking about? Is it closed-end or is it open-end? Or are they saying closed-end and using the term mutual fund? Okay. Audio is out. Okay. Let me know if you can hear me. Let me know if you can hear me. Let me know if you can hear me. How's that? Can you hear me now? Okay. All right. Thank you. Thank you for letting me know that. Not sure where I lost you. I'm going to go back to my open-end go back to slide 4, or the instructions, slide 4. This one? Did I lose you here at this slide? Okay. Wow. Okay. All right. So this slide, not sure where I lost you, but investment companies. This slide I summed up toward the end of this slide here by explaining that the definition of an investment company is a company organized as a corporation or a trust, as you see here. I believe you heard me explain that what they're doing is pooling money together, using it to go out and buy other people's stocks and bonds, creating portfolios of securities using mom and pop's money. Therefore, something called the Investment Company Act of 1940 required that if you're going to be using mom and pop's money to go out and buy other people's stocks and bonds with it, you got to let them know what you're doing with their money so they can assess the risk that you're going to be taking, right? So when these companies register with the SEC, which they're required to do if they're working with the public, per the, once again, the Investment Company Act of 1940 requires that they register with the SEC, and at that time they have to define specifically an objective. What are they going to be doing with mom and pop's money? Okay. The other thing that the Investment Company Act of 1940 does is it defines or gives us 3 classifications of investment companies. So the 3 classifications which we have here, base amount certificate companies, we have what are called unit investment trusts, and these actually unit investment trusts can be structured as fixed UITs or non-fixed UITs. I'm just going to briefly mention something about a fixed UIT, but the bulk of your questions are going to surround what are called management investment companies or funds. When we talk about a fund, we're talking about a management investment company. These can be structured either as closed-end managed investment companies or open-end managed investment companies. All right, excuse me. So what I want to draw to your attention is the term mutual fund. So you see mutual fund underneath the label of open-end. So it's very important that you understand that mutual fund and an open-end managed investment company are one and the same thing. So an open-end company, a mutual fund, they are one and the same thing. They will be using these terms interchangeably. So you have to be very clear that those are synonymous. They are not, however, the same thing as a closed-end fund. So with these questions, especially anything with the investment company questions, you need to first isolate what type of fund is the question about. Are they talking about a closed-end fund, or are they talking about an open-end fund? Or are they talking about closed-end fund versus mutual fund, meaning the same thing as open-end? So you just have to be very comfortable with the synonymous terms that you're going to be seeing throughout this exam and with the material all the way through. Because it's not uncommon. It's pretty frequent. I get asked a question, students quite frequently ask, when they have a question, they will hit a question, they'll say, Marie, this question's asking about a mutual fund, but it doesn't tell me whether it's open-end or closed-end. Okay, and I say, well, yes, it does. All right, the term mutual fund tells you that it is an open-end fund. That's all it can ever be. So open-end and mutual fund, one and the same thing. You also see, however, a reference to ETF under open-end. ETF stands for Exchange Traded Fund. Even though that is bulleted there under open-end, legally it is classified as an open-end fund, but please be very clear that an ETF is not a mutual fund. Okay, ETF is not a mutual fund. We'll talk a little bit about ETFs later on, but it is very, very important that you do not confuse or mistakenly refer to an ETF or pick an answer that refers to an ETF, as a mutual fund. Okay. All right. So what do you need to know then about some of the differences between these classifications? Well, the face amount certificate companies, you don't have to know very much. Let me just isolate them there for you. You don't have to know much about them at all. They're not really tested other than knowing that this is, excuse me, one of the classifications created by the Investment Company Act of 40. The portfolio of these companies, once they're put together, is not managed. So it means that there's no fund manager making decisions daily about what to buy and what to sell. And the securities that they issue are redeemable. So that's the term that I would become familiar with as well, and is a pretty important term with respect to this chapter. It's a key word for you, and I'll highlight what it is you need to remember about, redeemable versus another word you don't want to confuse it with. But that's a face amount certificate company. These aren't really prevalent today, so it's not something, like I said, that's really tested other than knowing it's a classification. Unit investment trust. So this is, we saw this as a type of investment company. Excuse me. And here, this is just referring to a fixed UIT, because you see this would be a trust that is using the money that they've raised to put together a portfolio of fixed securities. So that could be bonds or preferred stocks. But you also see the reference that this is a non-managed type of investment company as well. So the portfolio here would not be managed, which means it's a buy and hold type of portfolio. The board of trustees goes out, puts together or chooses which bonds perhaps they want to go out and buy with the money that they've raised, but then they just basically put them in a vault and let the bonds pay their interest, and as they mature one by one, so they don't all mature at the same time, they structure it so that bonds are sequentially or over time maturing, but as they're maturing, they're not being replaced. And while they have the portfolio, the bonds are not being actively managed. So this is a non-managed type of investment company, and the units that you would have here, not shares, but units, those as well are redeemable securities. Okay, so again, it's an important word, redeemable. So redeeming a security is not the same thing as trading a security, and that is very, very important. Those are words that can easily trip you up on answer choices through here, so you want to be very careful with the words. Trading involves the secondary market. Okay, redemptions involve selling your security back to the issuer. So you can see a big difference, right? Trade versus redeem. Watch for these words they're using in answer choices, because they are very specific words, and they can make a big difference between whether an answer would be correct or incorrect. So redeemable securities. Management companies. So we're going to look at the difference between the open-end and closed-end companies, but here these will have a fund manager, and so this would be a managed portfolio. So sometimes, again, depending on which test you're taking, but sometimes one of the questions they like to ask is, to see if you know what is the main difference between a unit investment trust versus a management company. And that's the main thing you want to think about. The UIT is the portfolio is not managed, whereas a management company, the portfolio is managed. And that can be managed either actively, meaning you got a human being making decisions when to buy, when to sell, what to buy, and what to sell, and that would be called, of course, active management. Or you could have a fund that is managed by a computer. If the fund's objective is to track the S&P 500 index, I don't really think there'd be much to do as for any human being that might have to sit and babysit that portfolio. You're not going to be doing a lot of trading with an index fund. Not a lot of decisions that have to be made. So those can be managed by a computer. And so that would be known as passive management, more like hands-off type of management. Computer does it. Associate a passive management with index funds. Okay, and so one thing I will also draw your attention to as well, though, with that word passive. So you're also going to, of course, come across words that it's the same word, but it can have different meanings depending on how we use it. And I've noticed over the years, I've come to kind of understand where students get stuck with some of these words or tripped up. And one of them is the word passive, because depending, once again, on which license you're doing, you may have come across something called a DPP, a partnership, direct participation program, which talks about distributions of income out of a partnership as being classified as passive income or passive losses. Don't confuse passive income with passive management style in a fund, okay? So a passively managed fund does not distribute passive income. So just be careful with the words and the meanings, and knowing when to, how to interpret them. All right, excuse me. So looking at the difference between, sorry about that, an open-end company versus a closed-end company. This is definitely something that you'll want to be familiar with, because they do like to ask questions really on all of these tests about, do you know the difference between a open-end versus a closed-end company? So we have charts, and these are in all the books, the table that compares open-end to closed-end. And this is one of the areas where I typically draw a silly little picture. I don't know, I'm going to try drawing just kind of an idea over this newspaper here. I don't know if you can see that very well, but usually for this concept here, I have my students think of a bathtub. Okay, so if you can see that, I don't know, and I can't change the color on that, but there's the idea. If you can't see it very well, imagine a bathtub. Okay, and if you can see it, you'll notice this bathtub has a drain. Okay, so think of a bathtub with a drain. The bathtub is empty. Think of the bathtub, that's what's going to hold our money. Okay, that's what's going to hold the money. The management company needs to raise capital to put together the portfolio. So they need to fill up the bathtub. And the drain is open on this tub. This is an open-end fund. This is a mutual fund structure. So they're going to turn on the faucet. Basically, they're going to start raising capital. And when they turn on the faucet, okay, I've always said it'd be nice to have a bathtub like that, right? You turn on the faucet and money starts pouring out. So this is the concept of, this is a company raising capital. So they would be in the primary market. And if they're in the primary market, then 1933 dictates that a prospectus would be required for everyone who is purchasing in the primary market. And in the primary market, we would not talk about trading at all. So we're going to talk about redeemable shares. We'll get to that. But the way that they're raising this capital is they're issuing stock. And with an open-end company, you'll notice that it says here that the way that a company, open-end company, can raise capital, the way they can fill up the bathtub, is by issuing common stock, and only common stock. Now, again, here, don't confuse this. It's not saying that all they can invest in is common stock. I get students will say, but wait a minute, I know that funds can invest in bonds because I own bond funds. It's not saying what can they invest the money in. It says they're only allowed to issue common stock. So mutual funds cannot borrow money from the public. They can borrow money from a bank, but they cannot borrow money from the public. So the way they're going to get their capital to fill up the tub is they're going to issue common stock to the public. Hey, would you like to be a shareholder in our company? Well, what are you going to do with my money? Oh, we're going to invest it in large companies, okay? Large companies that we think are going to grow. Oh, that sounds great. Yeah, that sounds really attractive. I'd like to be an investor in your company. So I invest my capital. It goes in the pool here, and I now own shares in this fund company. I don't own shares of what's in the portfolio. I own shares in this company, and they're going to take my money and they're going to use it to go out and put together a portfolio. All right. So they're doing what we call an IPO, right? In the primary market, we're filling this tub up for the very first time. And so that's known as an IPO. And in the primary market, you also know that all the shares that are sold in the primary market have to be offered for the same, what's called POP, public offering price. Everybody buys at the same price. All right, so, but because this open-end structure, so here they're issuing brand new shares, it's an IPO, but you see, because it is an open end, the drain is open. Therefore, as money can come in, money can also leave. Okay, the tub. So this money, this is people redeeming. Now, hopefully it can understand why we're using the term redeem. Okay, because we're not trading in the secondary market, we're still in the primary market. A mutual fund offering is a continuous IPO because the drain is open. You turn on the faucet, money comes in, money can flow out, and because the drain is open, the tub never gets full. It's a continuous IPO. It's an IPO that never ends. And so this mutual fund is constantly issuing brand new shares. These shares here that have been redeemed, they do not get reissued. They're now used, they have to be destroyed, and new shares just keep getting issued. They have an unending supply of brand new shares, all right? So, so that's why we're using the term redeem, and issuing common stock only, no secondary market trading. You want to look for the word redemption. And the price, supply and demand cannot set the price in the primary market. So that has to be calculated on a daily basis. We'll talk about that in just a moment. And you may or may not encounter a sales charge, or that can also be called a sales load. And that can be paid either when you purchase or perhaps on the redemption, one or the other, not both. And the maximum that sales charge can be 8.5%. That's certainly a number I would want to know. So that's your open-end fund. Leave the drain open on the tub. Okay. If we structure our fund company as a closed-end company, then in this case, oh, you know what? Let me try this. Let's try this here before I bring up Wall Street there. There we go. Okay, I can draw my tub for you. You can see it maybe a little bit better. And there's my bathtub, but now I've closed the drain. So this is going to be a closed-end fund. And a closed-end fund, if you look at the characteristics of a closed-end fund, it's going to actually have the same characteristics as any other type of what I call a traditional type of company. You could put Disney up here. You could put Walmart up here, and all of these characteristics would be true of those companies as well. What makes a closed-end company different than them simply is what they're going to be doing with the money. They're going to be investing it in securities. So again, they're regulated differently. So, but like a traditional company would, so here we've got a bathtub that is empty. They need to fill it up with money to put together the portfolio. How they go about raising that capital, they can issue common stock, they can issue preferred stock, they can also issue bonds. So again, just like any other traditional company could, they can borrow from the public, they can also issue stock and allow people to become owners in the company. The very first time they fill up the tub, that's going to be their IPO. Everybody has to receive a prospectus. But because the tub is closed, the drain is closed, there will only be so much room in the tub. So as we start filling up the tub, there is only so many shares available. As these shares are sold in the primary market, on the IPO, all of them sold for the same price, the tub is getting full. When the very last share has been sold, there's no more room in the tub, and that ends the IPO, and we have to then say we're out of shares. And if you were on the sideline saying, oh man, but I really wanted to get into that tub, you need to now find somebody that will trade places with you. Okay, so trading, these shares will trade in the secondary market after the IPO, just like shares of stock will. And so supply and demand will set the price, and you will have commissions every time you buy and sell, because they trade, again, just like shares of stock do. Okay, all right, oops. There we go. All right, so benefits of mutual funds. I think most of you are familiar I'm sure, with the benefits of mutual funds. So they are redeemable. Again, there's that word redeemable, which means you can get out of, they're very, very liquid. You can request a redemption anytime you want. Certainly if you're trading closed-end funds, those are very liquid. They trade on exchange and over the counter market. If you request a redemption from the fund, the fund has 7 days in which they have to get you your money. So very, very liquid, very, very marketable. Professional management, right? I don't have the time nor the desire to figure these types of things out. I'm going to let somebody else do it. Diversification, that's a very nice benefit. You know, you get access to and the benefits of a very diverse portfolio without having to have necessarily a lot of money. Everybody has what's called an undivided interest in what's owned by the fund, so it doesn't matter how little or how much you've put into the fund. Everybody has an undivided interest in what the fund owns and what it's producing. The fund holds the assets, so you don't have to worry about keeping those in your brokerage account. And the dividends and capital gains that the fund distributes, those you can choose as an investor whether you want to take those in cash or have them come into your brokerage account, or just tell the fund, hey, just go ahead and reinvest those. And that's a way that you can accumulate more shares over time and just have those go back into the fund. So I already mentioned that you can invest just about any sum. So all kinds of funds out there. There's thousands of them, lots to choose from. All right, now this slide here has to do with suitability. And suitability certainly is going to be a big part of any of these exams that you're taking. That is pretty much the bulk of what these exams are. They're all suitability and rules and regulations is what it boils down to. And certainly you're going to have across all these exams suitability questions with regards to mutual funds. And I'm not going to spend a lot of time specifically on suitability here because we have an entire webinar coming up later on in our series that's going to deal just with this topic. And I think, if I'm correct, that is one of the 90-minute ones. So it's going to be a nice, well-covered topic. So like I said, check that schedule for upcoming webinars and get your name on the list if you want to attend or at least get access to the recording afterwards. Very important topic. I would encourage you very highly to attend that one. So this table, like I said, I'm not going to spend time going over this table just because we have a lot of other things to cover, and you will get this table or something like it covered in the suitability webinar. But what I will touch on here is that what is also important when presenting mutual fund recommendations is that you, especially if you're laying out more than one fund for a client to consider, that you need to make sure that the investor is clear about the objectives, and if they're different, the difference in those objectives, the investment style, and how those differ. You know, is it value investing versus growth? The different objectives, right? Because those certainly can have a different reflection of return. If someone's looking at two different funds and they say, wow, but this one's got double-digit returns on average, and this one's only got, you know, mid-single-digit returns. Well, if they're two different objectives, then you can't really that's not really comparing apples to apples. So just got to lay out the differences, looking at the performance over time, going over sales charges and all the expenses, and educating the client as to how those expenses can impact ultimately their return. Okay. The table, I don't know if you have something like that in your book specifically, but you certainly have suitability types of tables and charts in your books. I do know that. So if you don't have this specifically, it's just helping you to see, again, the trade-off between risk versus reward. So that's something obviously that you should be thinking about with any type of suitability question. Always keep in mind the trade-off that comes between the more reward you want, the more risk you have to be able to take. So if you're not really willing to take a lot of risk, then you have to settle for lower returns. If your time frame, the top of that slide there, tenure of investment, how long before they're going to need the money, that will also play a big part in suitability choices. Okay, so suitability webinar, that'll help you with not only something like that, but also this kind of lends itself also to suitability types of questions. And the other thing I'll put out there and caution you or get you to start thinking about is that suitability, remember that this is suitability from the test perspective, whether that's FINRA or NASA, not your own experience and not taking into account, what's actually going on in the real world. And suitability, often students, of course, think that, oh, those will be really easy questions. I hope I just get a ton of suitability questions. These are and have always been some of the harder questions on the exam, right? Because it's just an area where your personal biases are going to creep in, and they're just going to taint the way you read a question or interpret a question. We've done it in classes where we've all read. I've had students, we go through some of these exercises as a group, and it's just really interesting to see the different ways that people interpret the exact same question. And it's just based on our own personal experiences. So it's a really hard thing to put your biases to the side, but as best you can, you need to start training yourself to look for just these keywords. They're in all of these questions. All of these questions are full of keywords. Your challenge is just to find them. If you can find those, and for some people that have a hard time with the suitability, what I suggest they do is, use your scratch paper that you're going to get in the test. As you're practicing, have scratch paper near your computer, and just as you hit keywords, just write them on your scratch paper, and then you'll have a little list of keywords, and then just look at that list. Don't get sucked up into the circumstances going around the scenario, because then that's when you start to read into questions or imagining or what ifing, and you can't go there. That's when you get into trouble. But if you look at just the key words and say, if someone just gave me this list of words, what would this make me think of? So for instance, the word growth, that could only be one thing, and that's common stock. Okay, so I don't care what else might be going on in that question. I see a word like growth as an objective. I know the answer has to have something to do with common stock. So it's just got to be automatic. Again, whether I agree with what the answer is not up for debate. So don't try and argue these questions. Just learn to recognize the keywords and pick what they want you to pick. One that I will, a couple things that I'll point out here. Income, I will mention income because this is an important one to recognize. A lot of times people think when they see income, they automatically think bonds. And that certainly could be true. You definitely invest in bonds for income, but please don't forget you can get income from stock as well. So if someone has income as an objective, then you gotta, there's another word you're going to be looking for to tell you whether you want to look for bonds or whether you should consider stock. But income, that can be bonds or stock. The other one here, growth and income. Be careful not to confuse this with a balance fund. That they're not the same thing. Okay, this is a growth and income stock fund. Nothing but stock in the portfolio. Some of it in there purely for the appreciation potential that it offers, and then other holdings there to produce dividend income. No interest income here, so there is no debt in the portfolio. So balanced fund would have both debt and equity in it. So just be careful again not to confuse some of this terminology. Bond funds, the keyword for bonds is safety. Okay, safety. That's how if someone's looking for income, you want to see them looking for safety. They want safety, a safe investment, secure investment. They're worried about losing their principal. Principal is a bond word. We never talk about principal with stock. So these are words, again, if investor has income as an objective and they want a safe investment, then I am going to be looking at a bond fund and not a stock fund in that case. So words like these, again, we're covering these in the suitability webinar, but these are the types of things, again, they just have to be automatic. And depending on the risk tolerance of your investor, the highest yields are going to come from corporate debt. The safest debt is going to be with the U.S. government. You're not going to get a lot of yield there, but it's the safety. So you have to figure out what's most important to your customer and identify their risk tolerance. All right, mutual fund pricing. So mutual fund, notice the heading of the slide here is mutual fund. So we're specifically talking about open-end or mutual funds. And since we now know that mutual funds, those open-end funds, the bathtub is open, the water's running, and it's running out the other end. So it is a never-ending IPO, continuous IPO. So on an IPO, the shares are priced, and all the shares are sold for that one offering price. But with a traditional type of company, at some point, they run out of shares, or like a closed-end fund. At some point, they run out of shares, okay? While they were doing the offering, all the shares were sold at the same price. Well, a mutual fund, an open-end fund, they couldn't set a price for the shares and leave it at that price forever and ever and ever, because that wouldn't make any sense. So what happens with a mutual fund, an open-end type of fund, is that the NAV, net asset value per share, which you see this formula here, I'd be familiar with it. Again, depending on which exam you're taking, you might have something come up. I really don't hear too much with people having to actually compute this, but recognize it, yeah, maybe. So I'd just be familiar with it, but you do need to know what NAV stands for, net asset value. And in this case, it's the daily price that's calculated for a mutual fund. You're going to associate NAV with the mutual fund, okay? And so this gets calculated, it has to be calculated at least once per day, okay? So at least once per day. And so the problem that some people see with or have with mutual funds is because the shares are priced at least once a day. Some of them, it'll tell you in the prospectus how often they compute their NAV. If the prospectus says we do it 3 times a day, then that's how many times they're going to do it, but they're required to do it at least once a day. And so if you're looking at a quote of a mutual fund and you see a price, NAV, and you're going to see what's called POP, public offering price, POP. So those are terms you'd associate with a mutual fund. And the thing that you have to remember, though, is what you're seeing when you see those numbers is you're seeing the last calculated price, the last time it was calculated. When you purchase a mutual fund, you don't get that published price. You have to wait till the next NAV is calculated. So it's what's known as forward pricing. And that's kind of the whole thing with mutual funds is you don't really know what exactly the price is going to be. So, some people are finding they don't like that, particularly in times like we've had in the past month or so, where markets are plunging rapidly. You can exit certainly, but you're not going to be quite sure of what the price is that you exited at until the next time they calculate the shares. Okay, so NAV, just be familiar with it and understand that when you're looking at published pricing, NAV and POP, you are seeing past pricing. That is not the pricing that the customer would receive. All right, so when I go to purchase mutual fund shares, if I want to invest in a mutual fund, there are different classes of shares that we can purchase. So we have A shares, B shares, and C shares that we're going to mention here. There are certainly other share classes as well. And yes, I know many firms do not allow their representatives to even talk to clients about B shares, but from a test standpoint, you still have to know about it. And it certainly could be something that you might need to consider for a suitability type of question. So, with your A shares, go back, just do one at a time here. So if the investor is investing into a mutual fund, again, remember that's going to be an open-end fund, there may or may not be a sales charge or sales load. We saw that in that little chart just a moment ago. And this sales load can be associated either with the purchase or upon the redemption. Once again, one or the other, they don't hit you coming and going like you do when you're trading in the secondary market, commissions both when you purchase and when you sell, but not in the primary market, or not when you're investing in mutual funds. So we call it the maximum sales charge is 8.5%, as you see there. I don't know of any off the top of my head that are actually charging that much anymore today, but they are allowed to go that high if they so choose. But just because that is the maximum, that doesn't mean that that's necessarily what you're going to see out there. And you'll also notice the other thing that I always like to point out, and you want to be careful of, is it's 8.5% of the POP, okay? Not 8.5% as a percentage of the NAV, but 8.5% as a percentage of the POP. Okay, so when a customer goes to purchase a mutual fund, they can choose how they want to pay the sales charge. If they want to just pay it right up front, then they would be purchasing what's called an A share. Okay, so front end load. Now, aside from the sales charge, there are other expenses as well that ultimately the customer pays for, but those are expenses that get deducted by the fund, right? So the cost for the fund manager, the cost for the custodian bank, the cost for the transfer agent, accounting, right? So there's all these other expenses that are related to the management of the portfolio. But what happens is the company, all the money is generated by the portfolio, they just deduct these expenses, and then with what's left over, that's what they're going to be distributing back to their shareholders. And we're going to look at distributions here in just a moment. But the point that you want to think about, again, not just with mutual funds, but throughout, but definitely relevant here with mutual funds, is considering the effect of expenses. The higher the expenses, the more that's being deducted, the less I'm going to get returned to me as an investor. So between the sales charge, no one likes the thought of paying a sales charge, but you're going to pay. You're going to pay one way or the other. It's just how you want to pay it. Do you want to pay it all at once and like rip the Band-Aid off and get it done with? Or do you want to, have it not be as obvious and just have it come out in the form of, hey, why don't you just deduct some higher expenses over time? And that's what a B share is going to do. So A share, if the customer opts for A share, the sales charge would be deducted upon the purchase going into the funds, and the sales charge would get deducted, and then the remainder is what gets invested into the fund. So an A share is the only one that utilizes the POP. Okay, A share will come in at the POP, but when you redeem your shares, A shares will redeem at NAV. And since you've paid your sales charge up front, the other operating expenses associated with A shares will be lower than they will be with the other share classes. Okay, so again, you're going to pay one way or the other. You just either get it done right away and or have it come out over time. Okay, B shares, for the customer that doesn't like the thought of taking that hit as soon as they go into the fund, then B shares would be the share class to recommend. With B shares, 100% of the investment is going to get invested, and the only way that someone would be subject to a sales charge would be if they redeem during a specific period of time. It's what's known as a CDSC. That stands for Contingent Deferred Sales Charge. Contingent, it may or may not happen. Deferred, it's pushed out into the future, this sales charge is. So it's basically like a surrender charge, that if you, redeem shares in year one, the fund company will deduct, let's say 6%, if that's their highest sales charge. They'll deduct 6% and give you the rest. If year two, that would drop maybe to 5%. Year three, it drops to 4%. So the longer you own your shares, the smaller that CDSC becomes, until eventually it gets to zero. And then what happens with the B share, it's kind of interesting what happens. Now keep in mind, during the time that you're in this CDSC, since you're not actually paying a sales charge up front, it's not that you're avoiding the sales charge altogether. Where the fund is going to collect it is in the form of higher 12B1 fees. Okay, so B shares will have higher 12B1 fees than A shares because you're choosing basically to pay your sales charge over time. Okay, so, but then with the B share, once the sales charge gets to zero, what happens is the B shares convert to A shares, and then the 12B1 drops, and then you're starting to get more money returned to you at that point. So both A and B shares are suitable for people who have long time horizons. I'd say 5 years or more from a test standpoint. 5 years or more, you want to think A or B. And then the difference of which share class to choose, A versus B, has to do with whether or not they qualify for a breakpoint. We'll talk about breakpoints in a moment, but if they qualify for a breakpoint, you're going to go with an A share as a recommendation. You see if they do not qualify for a breakpoint, if they have smaller investments, they're dollar cost averaging, $100 a month or something, then B share would be the thing to consider for that investor. Okay, the other share class that we have is a C share, what is also known as a level load. Okay, and a level load, these C shares are going to be suitable. The key here is the time horizon, short time horizon for the C share. There, they've got 2 to 3 year time horizon. Anything less than that should be in a money market fund. So 2 to 3 years here. And the deal with the C share is no sales charge going in. It does have a CDSC, but only for the first year. And then at that, it's only 1%. But remember, if you're not paying a sales charge, you're going to get hit someplace else, and you're going to get hit in those 12B1 fees. So C shares are going to have high 12B1 fees, just like a B share will. The difference is that, as I mentioned, the B share, at some point, those 12B1 fees will drop. So it'll go from a higher 12B1, but then they drop down. The C shares, the 12B1 is high, and it stays high the entire time. That's why they call it a level load. So even though these might seem to be the best way to go, because, wow, as long as you don't redeem in the first year, you don't have a sales charge, that's true, but you've got those high expenses the entire time you're in the share class. So over time, these actually, these are very expensive, okay? And the investor would actually be worse off in the long run with C shares than they would have with, say, an A share. All right, no load, we all have heard and understand what this term means, but do you really understand what it means? If I asked you to define a no load fund, you'd probably say, oh, well, that means there's no sales charge. And that's true, okay? And that is one of the parts of the definition, one of the parts of the definition of no load. So do be careful with this. You do need to know the definition of what is or what constitutes a no load fund, to be able for a fund to describe itself as no load, or for you as a representative to be able to describe to a customer a fund as being no load. You need to know what that means. It means no sales charge ever, but it also has to do with the 12B1 fee. You have to look at that. To be able to say the fund is no load, the 12B1 fee cannot be more than 0.25%, not 25%, but 0.25%, or also could be worded as 25 basis points. So I would know the definition of no load, because if they threw something in there that a rep is describing a fund that has no sales charge and a 12B1 fee of 0.27% and is describing it to a customer as no load, which of the following is true, right? And then you've got the answers down there. This is a violation. This is not a violation, right? And understanding, is it or is it not? Well, can you describe it as no load if it's got a 12B1 fee of 0.27? Nope, you cannot. Even if there's no sales charge, If the 12B1 fee is greater than 0.25, you have to describe it, and the fund has to describe itself as having a sales charge. Okay, so that's no load. I doubt you're going to see that in suitability questions, but you need to know what the definition of no load is. Okay, the test tends to surround itself understanding the impact of fees and charges. So you're going to be having to make choices from A, B, and C shares. Okay, but you do need to know, again, definition of no load. All right, now breakpoints. We just got done talking about A shares versus B shares and when to choose A, and if you've got a 5-year or longer time horizon, and if the customer qualifies for a breakpoint. A breakpoint is a reduction in sales charge. So here you can see the reduction in sales charge starts at, depending on how much you're investing, anytime new money comes into a fund, one would refer to the breakpoint schedule if there is one. There doesn't have to be one. This is what's called a privilege that the mutual fund may choose to offer. If they're offering breakpoints, you would find this in the prospectus. And don't memorize this chart by any means. The funds can make up their own breakpoint schedule. So this is just to give you an illustration of what they mean. So you can see that the more money I invest with a fund company, and it doesn't all have to go into the same objective within that fund family, but I bring my money to a fund family, and based on the amount of money I'm bringing them, right, it's quantity discounts. They will reduce the sales charge as an incentive to bring it all to them. So let's say if I had just inherited, let's say $100,000, and I wanted to invest it into the Rocky Mountain Mutual Fund family, the Rocky Mountain Mutual Fund family, as an incentive to bring all my money to them, they might say, hey, Marie, if you brought us anywhere from 0 to just under 25, we'd hit you with a 6% sales charge, but bring us your full 100,000, we'll drop that down to 4. Okay? Again, it doesn't all have to go into just one fund. You can break it up and disperse it amongst our choices that we have available to you in our family. But this is the benefit of a breakpoint, quantity discounts. Okay. So like I said, if the customer qualifies for a breakpoint and they have at least 5 years, you should be recommending A shares. Now, what if instead I came to you with $20,000, just $20,000, I wanted to invest in, that into the Rocky Mountain Growth Fund. Okay, $20,000, we'd find that. You'd say, all right, I'm going to pay 6% sales charge. Now, if you're my representative and if you're looking out for me, as you should, then you should point out to me that my 20, look, I'm awfully close. If I had another $5,000, I could get a reduced sales charge. I could, put more of my money to work rather than giving it to the investment company in the form of a sales charge. So you should be mentioning to me as my representative, Marie, do you have another $5,000 you can add to this? Because if so, you can save yourself some money and put your money to work. And I say, I don't have $5,000. This is all I've got. In which case, then you might want to mention, well, you don't need to have it right at this minute. Do you think you might be able to come up with it in the next 13 months? If so, then you would tell me about something called an LOI, a letter of intent, right? And this is something that you would have me sign, and it would go in with my $20,000 I'm investing today, and that tells the mutual fund that I plan to come up with the amount of money necessary to qualify for the next breakpoint. They will give me the benefit of the doubt, and they will go ahead and apply that lower or reduced sales charge to the $20,000, and I then have 13 months to come up with the additional monies. Now, this is not binding on me. If I don't meet the letter of intent, what happens is the mutual fund company will just hold some of the shares, the differential, the 0.5% difference, they'll hold in escrow, shares equivalent to that amount. If I don't meet the letter of intent, they'll just liquidate those shares to collect what they should have collected at the beginning. Okay, so that's the letter of intent. It's good for 13 months from the date that it is signed. Now, if I didn't sign the LOI, I just said, no, I don't think I'm going to have any more money. Just go ahead and invest it. And so I don't sign the LOI. But now I come to you 2 months later, and I've got another $30,000. and I say, I wasn't expecting this. I got a little bit of a windfall. I'd like to go ahead and put this with that other money that I put in a couple months ago. So again, if you're my representative, if you're on my toe, or not on my toes, but if you're on your toes, then you should be thinking, hey, wait a minute, you know what? That letter of intent, I know you didn't sign it when you put the 20,000 in, but you know what, Marie? Those can be backdated up to 90 days. So we'll pull one of those out, and we'll just put the date on the bottom equal to where when you put the 20 in, right? And then in goes the 30 on top of it, and the lower or reduced breakpoint will be applied to all of it. Okay, so all funds offer the LOI, rights of accumulation. Let's say my $50,000 is in there. It grows to $86,000, and now I want to put in another $20,000 of new money. If the fund only offers rights or breakpoints, then that $20,000 would go in at 6% sales charge. But if the fund offers rights of accumulation, I get to take the value of what has accumulated in the fund at that point, $86,000, and plus the 20 I'll be putting in new. Together that would make $106,000. That would drop me down to a 4% sales charge. So this is a privilege. Again, funds do not have to offer rights of accumulation, but it is definitely beneficial in helping new monies qualify for breakpoints based on what's accumulated already in the fund. Okay, who cannot take advantage of breakpoints? Investment clubs cannot take advantage of breakpoints. And while breakpoints are good, breakpoint selling is not good. So breakpoint selling, if you're an unethical representative, rather than thinking of the client and looking for ways to get the lowest sales charges possible, you're thinking about your own paycheck and your own financial situation before the clients, and just looking to make more money at the expense of the client. That obviously is not the ethical thing to do. And if you're caught engaging in breakpoint selling, that is a no-no. So, but again, watch for this, how they ask it. Breakpoints are good. Breakpoint selling, not good. All right, conversion privilege. All funds allow you to move within the fund family from one objective to another without incurring another sales charge. Again, they want to see you staying with the fund family, so they will allow you to go NAV to NAV, to one objective to the other. So that's known as a conversion privilege. Please, however, understand that you're going from one company to another. It's like going out of Home Depot and going into Lowe's. Okay, you need to sell shares of one to purchase shares of the other. Same thing here. Even though you're staying within the same family and there's no sales charge, you're redeeming shares in order to get the money to go into the new fund. So there could be tax consequences, and you definitely need to be disclosing that to your client. Otherwise, they will be very unhappy when they get that tax bill. All right, now funds are required to make distributions annually. So there will always be a tax consequence with your mutual funds, and they're required to distribute what's called the net investment income. So I would be familiar with this formula. The net investment income represents what is generated by the portfolio. Depending on what's in it, stocks, you would be getting dividends. If there were bonds, then that would be generating interest. So there's revenues flowing into this company. Remember, it's a company. They're generating investment revenues here, dividends plus interest. The IRS sees this. The government sees it and says, hey, you're a company. You have revenues. We think you should be paying taxes on those revenues. The mutual fund company said, well, we are generating revenues, but it's not for us. These monies belong to our shareholders. And for us, it's not a decision about do we want to pay a dividend or not. We are going to be paying all of this out. So we don't think you should tax us, and then you're going to tax the investor too. That doesn't seem right. So the tax code has a provision in it, something called Subchapter M. It's not listed here, but Subchapter M. And Subchapter M says that if a mutual fund can prove that it's acting as a conduit or a pipeline, then no taxes at the corporate level will be due on that net investment income that's distributed to their shareholders. But to qualify for this, they have to prove that they are distributing, as you see, at least 90% of the net investment income. There you go. So 90% of that net investment income. Okay, so I would know how to compute this one perhaps, and I definitely would know the 90% if they said how much does a company, does a fund need to distribute in order to avoid paying taxes. You would need to know how to compute it, dividends plus interest minus expenses, and then know to take 90% of that to come up with your number. Okay, the investor absolutely is going to pay taxes on those dividends. That will be ordinary income to the investor. Capital gains are something else that a fund is required to distribute. This is going to happen as a result of sales of securities in the portfolio. If the fund manager sold a position and made a gain, then those gains are taxable, and those taxes, however, are paid by the shareholders, not by the fund company itself. So capital gains and income, dividend income distributed by the fund on a 1099, you can kind of see it under the pen there, the 1099 DIV, and you as the individual report those on your tax return. Again, regardless of whether you're reinvesting them automatically or not, it doesn't matter. You have to report dividends and capital gains on your tax return. All right, more fund types here: global versus international versus funds of funds. Global and international held for diversification purposes. Excuse me. And I would just watch here global specifically. Just remember that includes the U.S. International is everything outside of the U.S. So if someone already is heavily weighted or has a good amount of U.S. holdings and they're looking to diversify, you wouldn't want to give them a global fund. Give them just international. But if someone wanted just one fund that would give them broad diversification, a global fund would be, one fund that would hit all areas of the globe. Fund of funds, one-stop shopping. You can get a variety of different mutual funds all in one fund. So if you don't want to hunt around, again, ease of having it all in one fund portfolio, a fund of funds might be something to consider for that type of client. All right, ETFs, we saw these mentioned when we were defining our different types of investment companies, the management investment companies, open-end versus closed-end. Remember, these were listed under open-end, and here you see classified as open-end, but they are not mutual funds. All right, exchange-traded funds. Okay, the word traded there, okay, for you, tells you they cannot be mutual funds. Remember, okay, mutual funds and the word trade cannot go together. These trade in the secondary market, so supply and demand will set the price. They are extremely popular and widely used. They're very appealing because people like being able to time their entries and exits. They have other benefits as well. They're marginable. You can also buy them using margin. You can sell them short. These are things you could not do with a mutual fund. And they're very low expense, so that's also very appealing. Low expense ratios, and they are very tax efficient as well. In a lot of cases, they can be more tax efficient than mutual funds. Again, mutual funds have to make those distributions. They have to pay out their net investment income, otherwise they get taxed on all of that money. So ETFs do not have that requirement. So for someone who's in a higher tax bracket, an ETF might be better for them than a mutual fund. All right, hedge funds, we all know what these are. These are funds for rich people, right? Rich people and institutions. And so since these are people that are more sophisticated, right? Sophisticated investors, they're pretty savvy. They can determine and decipher whether something is suitable for them or not. And so they do not have to register with the SEC. They can do whatever really they want as far as investment strategies go. And they definitely do take risks that you would not find funds that are geared toward mom and pop would be taking. All right, so switching here, our last couple of slides here, we're going to switch gears and talk about other package products, something known as an annuity. Now, annuities are insurance products. So you would need an insurance license, life and health license, to be able to work with annuities. They are, depending on what kinds of annuities you are working with, if they're variable annuities, you'll see there's two different types, fixed annuities and variable annuities. Fixed annuities, you would need just an insurance license to work with those. But if you're going to be working with variable annuities, variable life insurance, anything with the word variable, variable means it's a security. And so you'd have to have a securities license to be able to work with the annuities as well as the insurance license. So the other thing you want to keep in mind is that these are retirement products. Okay, they are retirement products. So they would only be suitable to recommend for someone who has retirement as an objective and has already maxed out their 401k or whatever their retirement plan at work is. They've already put the max they can into a Roth, and they still want to squirrel some money away. An annuity might be suitable for that type of person, or for someone who is worried about outliving their retirement savings, right? We hear a lot of people worried about, they're hitting retirement and they have hardly anything set aside. They're worried about outliving their retirement. Also hearing about people living longer and longer. So it is kind of scary. So this is the only type of product really that can offer someone the potential for a guaranteed income stream for life. So that's a bonus. But benefits don't come without costs associated with them. Nothing comes for free. So the trade-off's going to be, there's going to be higher expenses here. And then there's lots of different types of annuities. So please, if you're coming from an insurance background, do not go deep with this. All right, this is just a definition of what an annuity is for those that have never seen these, heard of them, or dealt with them. So if you are familiar with these products, please do not overthink this. Do not go deep into the different features that you might be familiar with. Just keep it very, very definitional here. Annuities can be, again, they are retirement plans. So someone should not need this money until they're at least 59 and a half. Otherwise, they'll be subject to early withdrawal penalties and possibly penalties from the insurance company as well. And then taxes. You always have to keep in mind tax consequences with these. So annuities, if they're funded with after-tax dollars, you might want to write the word non-qualified annuity. Okay, there's non-qualified annuities, and then there's qualified annuities. The difference has to do with whether they're funded with after-tax dollars or pre-tax dollars. And that will impact how much of that money will be taxed when it comes out of the annuity. If it's funded with after-tax dollars, if it is a non-qualified annuity, the money you've put into the annuity is already been taxed. So it will not get taxed again when you take it out. It forms or creates what's called your cost basis in the annuity. It's going to grow tax deferred. And again, the idea here of an annuity is to provide income for me at retirement. These are not designed to take care of other people. These are designed to take care of me. Okay, and since it is a non-qualified annuity funded with after-tax dollars, all of the growth that's been deferred while it's been inside the annuity will be taxed when it comes out, taxed as ordinary income. Any type of distribution, taxable distribution from a retirement plan, will always be taxed as ordinary income. Don't ever pick capital gains with taxable retirement distributions. All right, fixed annuities. The insurance company guarantees a return. So if you have guaranteed returns, that is not a security. But a variable annuity, the insurance company is going to let you pick and choose how you want to invest the money. Okay, and since you're in control of how to invest it, there is no guarantee about return. So you, the investor or the annuity holder, have the investment risk. And that's why a variable annuity is considered a security. So within the annuity, the variable annuity, the variable annuity, which is regulated under the Investment Advisors Act of 1940, it's also regulated under the Securities Act of 40 and insurance regulations as well. There are lots of regulations surrounding variable annuities. What happens is the money's here, since you're going to be able to pick and choose how you want to allocate your monies that are coming into the annuity, since you're going to be in charge of the allocation. Within the insurance company, there are two accounts where money can be directed. They can go into what's called a general account. We're not going to talk about that here, and that's money that the insurance company manages and is in control of, making decisions over. But the money that you're going to be making decisions over, they're going to keep that separate. So the separate account is really just a big pool of, they call them sub-accounts, as you see there. Sub-accounts, they're really just like, you can think of them as mutual funds, but they can't call them mutual funds because they're inside of an annuity. So they call them, the true term for them is sub-accounts. But so the separate account is just made up of a bunch of sub-accounts. I liken it to, I always use if you think of, if you got a 401k or some type of retirement plan, you know that your employer gives you a selection of funds. Here's what's available. Okay, we've put together the menu, if you will, but you, individual, can pick and choose which of these you want to use, how much you want to allocate. You choose when to move the money around. A variable annuity is the same type of thing. That's what the separate account is. There's lots of choices. The menu is in there. And then you choose how to allocate the monies that are going into that separate account. So since you're in control, once again, no guarantees about return. Okay, so you've got the risk. And with a variable annuity, if you want the guaranteed income stream for life, then you have to annuitize the contract. And what you'll just want to keep in mind with a variable annuity is that check that you're going to get every month, it can and will vary, meaning that you can't predict what it will be from one month to the next. If someone wants predictable monthly income and guaranteed income for life, then they want the fixed annuity, because that one will give them a fixed payment every single month. All right, so the two phases to pay attention to here, and these are key words for you with annuities, and that is the accumulation phase, which is when you're putting money into the annuity or can put money into the annuity. And then there's the annuitization phase, payout phase, we call it. So pay in, accumulate, that's while you're accumulating. And you might just be paying in or just put in one lump sum of money and never put in any more. But until you actually annuitize the contract, you're technically not in the annuitization phase. Okay, so your separate account is still accumulating until you annuitize. So, and why I bring this up is because you want to pay attention to the reference to units. So you don't have shares. Okay, it's an insurance product, so we don't talk about funds. We talk about sub-accounts. And you don't talk about shares. You have units. So during the pay-in phase, okay, I'm purchasing what are called accumulation units, which makes sense. I'm paying in money. I'm accumulating. So the number of units that I have is going to vary in terms of how many units, because I'm accumulating. And depending on which of those menu options I've chosen in the separate account, the value of my units will vary as well, just like they would in mutual funds. Day to day, values up, values down. So during the accumulation phase, the contract holder is purchasing accumulation units. So you need to pick up on that. If they're talking about accumulation units, you need to associate that with the pay-in phase of the contract. Okay, accumulation units, pay-in phase of the contract. If they're talking about annuity units, notice annuity units here. Okay, annuity units, okay, that would be associated with the payout phase. That tells you the payout phase of the contract. And this means that the client has instructed, I want to start getting an income stream for life. So at that point, the insurance company says, all right, in that case, you cannot put any more money into the annuity. So once they go into annuitization, the accumulation phase is over, and now the insurance company takes over, and there's someone called an actuary that will calculate how much they're going to pay this individual 1 month to the next, okay? And there are various factors that will affect the amount of the check, but certainly one of the things that they use to do the calculation is something called AIR, the assumed interest rate, right? They have to do basically a future value projection about between now and my projected death date, what's called my expected mortality date. They have to project what they think, the money will grow to between now and then. And so they have to assume an interest rate that it's going to grow by. So if you will, think of that as like the expected return. That's what they expect the return is going to be on this money. All right. And so they do the calculation, and the idea is that it's calculated worst case or break even for the insurance company. I die when I'm expected to. By then they will have paid me back all my own money. Nothing out of the insurance company's pocket. They're just paying me back my own money. But they're allocating it to me. So if I annuitize, I don't have any control over this money anymore. I can't call them and say, hey, I need some more. Or I can't say, hey, I'm getting more than I need. I'm going to have a tax problem. Can you just hold off on the payments? Once the annuitant, as we'll call them now, starts this, you can't shut it off. Okay, so the actuary would do a calculation. You won't have any calculations here, so don't worry about this. But I would definitely be prepared to be able to determine from 1 month to the next, the check that they receive, is that going to be more than they got last month, less than they got last month, or the same? So you'll just have to evaluate, will the check go up, down, or remain the same? And the way that that's done is by, again, the projection, the expected return, which was done by assuming an interest rate, comparing to what the performance of the investments actually did. So it's basically just actual return compared to the expected return. If the actual return is better, then they're going to send him a bigger check. If the actual return was not what they were projecting, then the next month's check will be something less than they got the month prior. If the return was right in line with what they were assuming, then the check will be the same. Okay, then they got the previous month. So your books will have examples and little tables illustrating that. I would encourage you to look at that. It's a lot easier to get a feel for the numbers by looking at numbers. But you want to definitely look at that. But what I will highlight for you or draw to your attention is that when are we comparing to air? You compare to air, okay, during the payout phase. Okay, we're comparing to air during the payout phase, not during the pay-in phase. So if they're talking about annuity units would involve compare to air. Okay, accumulation units, we don't compare to air when we have accumulation units. Okay, so you're going to want to watch for that. Okay, all right. So I believe we have just a few minutes here. So let me see here. Let me see. I think that is the end. Any questions? I know Mark's been taking your questions, so I hope you got all those into the chat there. Whew, we covered a lot of ground in 90 minutes. It flies by, at least on my end it does. I hope you got something of value out of this today. The next three options, just to let you know exactly, Mark's posted it there for you. Next three options will be on options. So some of you need more or will have more questions on options than others. So we have 3 different sessions. Look those over if that's something that you are looking for some guidance on, or some just kind of, again, an overview. See if it appeals to you, if it's relevant to you. And then if so, I would encourage you to sign up for those. Other than that, like I said, take a look at the upcoming webinars and gigs. Taylor Stevenson will be your instructor for the upcoming options webinars. I, Marie Sychowski, will be back with you again for economics. I may or may not be doing one other one in between now and then, but I thank you, and we thank you for choosing Kaplan. Be well. Keep up with your studies. You've got to look at this stuff every day. And I know it's kind of hard with the testing centers not being open, but do something with it every day. The stuff will go very stale if you put it off and think you can just pick it up and have it all come right back. It does not stay fresh. So get into the QBank, Look for suitability questions. Also look at your, I always like to mention the Kaplan dashboard. Okay, go to your Kaplan dashboard and exam tips and content updates. You got a little button there. Please take a look at that, everybody. That is very important information, not only about just the material itself, updates that we might want to alert you to that might be relevant to your exam, but you might also find a lot of suitability related information there, depending on which test you're taking. I know that for some of those licenses, we have quite a bit of very, very beneficial information there. I've had previous students attest to the fact that the information there helped, put several points in their plus column that could have, helped make or break the difference for them. So please take a look, exam tips, content updates, take a look at the postings that we have there. If there are any final questions, we will be here for got about another minute. We'll take a look at the chat. Otherwise, I thank you very much, everybody. Have a wonderful rest of your day.